Every empire swears its money will last forever. Every ruler insists their currency is strong enough to hold up the world they have built. And every citizen clings to the belief that the number printed on a coin or a note will always equal the labor, the bread, and the roof it once bought, until history proves them wrong. And the moment comes when what was trusted as solid turns worthless in a single breath. We treat money as if it is permanent, a foundation as certain as stone. But money is not stone. It is trust, and trust can crack. That crack has echoed through history more often than peace, more often than prosperity. Collapse is not a rare event. Collapse is the rule. Take the Byzantine Empire. For centuries, it looked like the exception to that rule. When Rome had already fallen in the west, Byzantium endured in the east, and at the center of its strength was a coin, the gold solidus. It was a marvel of consistency. For more than 700 years, this coin barely changed. Its weight was stable, its purity remarkable, its acceptance universal. A merchant in Damascus or Venice, Cairo or Kiev, knew exactly what a solidus was worth. It was the closest thing the medieval world had to a global reserve currency, and that stability gave Byzantium power far beyond its walls. But the same mistake always waits. Rome had debased its silver denarius until it was little more than tin with a thin wash of shine. You would expect the Byzantines to remember. Yet centuries later, they began shaving their gold, a little copper here, a little silver there. At first, no one noticed. The coin still gleamed, but purity slipped. Then it slipped again, and when trust faltered, the coin that had anchored Mediterranean trade became nothing more than a political promise. Debasement destroyed credibility, and credibility was the only thing that coin had ever really been. As the purity vanished, so did confidence. Merchants demanded more coins for the same goods. Foreign traders began to favor silver from elsewhere. The empire that had outlasted the West saw its economic foundation rot from within. The gold solidus, once an unbreakable guarantee, was now an echo of itself. Who survived that change? Not those who clung to the emperor's promise, not those who trusted that a symbol stamped with imperial authority would retain its power forever. The survivors were merchants and families who held value outside the emperor's grasp, land that could feed them, silver that kept its weight, gold hidden before the mint touched it. Their wealth lived on, while paper decrees and hollowed coins turned to dust. That is the first pattern, and it repeats endlessly. Governments cannot resist the temptation to dilute money. They always claim it is temporary, that it is for stability, that it is patriotic. But every time rulers stretch their coinage or flood their economy with promises they cannot keep, value flees. It flees into things they cannot counterfeit. And this is why money's death never looks sudden to those who watch closely. The collapse of the Byzantine solidus was not an accident. It was a slow decay of trust, visible to anyone who noticed the lighter ring, the duller shine, the creeping suspicion that what had been eternal was now fading. The lesson is harsh but clear. Money dies not when the last coin is struck, but when the last person stops believing in it. Once that trust evaporates, the collapse is irreversible. You cannot legislate it back into existence. You cannot order people to pretend that paper is still bread. Trust does not obey governments. It obeys reality. And the reality, repeated across centuries, is that when money dies, something else always takes its place. It might be gold, it might be land, it might be food, but it is always something beyond the reach of rulers, something that can hold its value without a signature or a stamp. That lesson began with the fall of Rome and echoed through Byzantium. It is the ground rule of history. Money is temporary, value is not. Revolutions promise freedom, but more often than not, they first deliver broken money, and no amount of speeches, banners, or patriotic oaths can feed a family when the currency in their pocket has already died. In the 1790s, France learned this lesson the hard way. After the monarchy fell, the new revolutionary government found itself in control of vast amounts of confiscated land, especially from the church. To fund their cause, they created a new currency, the assignat. On paper, it looked brilliant. Each note was backed by the value of those lands. And to a people hungry for change, it felt like proof that wealth had finally shifted away from kings and bishops and into the hands of ordinary citizens. But promises are always easier to print than reality. Every new issue of assignats stretched the connection to land thinner. At first it seemed bold, even patriotic. Farmers sold food for paper. Merchants accepted it as payment. But soon the government issued more and more. Each note diluted the last. Confidence cracked, prices began to rise. Wages could not keep up. Within a few years, the assignat was worthless. Paris felt the collapse in its most basic form: bread. Farmers refused to trade loaves for slips of paper no one trusted. Riots broke out in the capital. Crowds demanded food, not paper. The same revolutionaries who had celebrated their new money now discovered that printing land on paper was not the same as having land you could touch. The lesson here was brutal but plain. Political promises cannot be eaten. Only real value feeds people. In revolutionary France, the winners were not those waving patriotic notes but those who held silver, grain, or property, things the government could not print. The same pattern appeared decades later, this time in America, not through revolution but through war. The Civil War was fought with rifles and cannon, but also with printing presses. Both the Union and the Confederacy needed money far beyond what they could collect in taxes or borrow. Their solution was paper. In the North, the government issued greenbacks. They were not backed by gold, only by the promise of the United States itself. At first they inspired trust. Citizens treated them as symbols of national unity. But as the war dragged on, more greenbacks poured into circulation. Each new issue bought less than the last. Inflation rose, and the purchasing power of the notes eroded. In the South, the problem was even worse. The Confederacy printed greybacks in staggering amounts. By the war's end, they had become almost meaningless. Soldiers received wages that lost value before they could even be spent. Families carried bags of bills that could barely buy a loaf of bread. Inflation reached thousands of percent. Confederate currency did not merely weaken, it died outright. And when the money died, the same cruel division emerged. Those who had trusted the government's paper found themselves ruined, while those who had invested in land, livestock, or goods held something that still mattered. For ordinary Southerners, lifelong savings became ash on paper. For opportunists who held real assets, the war was a chance to buy property at a fraction of its former price. What ties these stories together is not the ideology behind them, revolution in France, war in America, but the mechanism. When governments print more promises than value to back them, collapse follows. And when collapse comes, the survivors are never the ones clutching stacks of patriotic notes. They are the ones holding what governments cannot inflate away. This is why money's failure is not an accident of politics or war, but a certainty of human behavior. Rulers reach for the printing press because it is easier than discipline. They flood the economy with paper. They assure citizens it is strong, and for a while the illusion holds. But once trust cracks, the speed of collapse is merciless. Think about a shopkeeper in Paris during the Revolution. One day, he trades a cart of bread for a pouch of assignats, believing he can restock tomorrow. A week later, those notes buy half as much. A month later, they buy nothing. Or a Confederate soldier in 1865, holding pay that could once feed his family but now won't cover even a meal. Their stories are separated by oceans and centuries, but their fate is the same. Trust in paper led to ruin, and so the pattern repeats. Whether it is revolutionary France or Civil War America, the lesson remains identical. Printed promises are not wealth. They are only symbols of wealth, and symbols can vanish in an instant. The people who survive are not those who trust the paper most, but those who hold value that cannot be diluted. The danger of dead money isn't buried in history. It happens in the present, in places where people once believed their banks, their governments, and their currencies were safe. Between 2019 and 2021, Lebanon became the most recent reminder. For years, the Lebanese pound was treated as stable. Banks were trusted as vaults. Families saved, retirees deposited, and businesses planned around accounts that felt permanent. Then, almost overnight, that trust collapsed. Banks closed their doors. Withdrawals were frozen. People lined up outside branches, pleading for access to the money they had earned, only to be told it was no longer theirs to touch. The currency lost more than 90% of its value. A lifetime of savings shrank to pocket change. The lesson was as brutal as anything Rome or Byzantium ever endured. Your money in the bank is not a treasure chest. It is a loan you have made to an institution. And in a crisis, that institution can decide not to give it back. Those who had diversified abroad or kept assets outside the banking system survived far better than those who placed blind faith in the vaults of their own country. Americans like to think that collapses of this kind belong elsewhere, but the truth is closer to home. In 2008, when the housing bubble burst, millions of families lost their homes, their pensions, and their sense of security. The institutions that failed them, the same ones that had inflated the bubble with reckless lending, were rescued. Homeowners were not. The banks that were deemed too big to fail were kept alive with bailouts, while ordinary people carried the loss. And even more recently, in 2023, regional banks in the United States collapsed almost overnight. Depositors panicked, confidence evaporated, people rushed to withdraw funds, only to be told the same story that has repeated for centuries. Money is not bedrock. Size does not equal safety. Trust can vanish in a single day. Look at these stories together. Lebanon, 2008, 2023, and the pattern is impossible to ignore. Institutions survive for themselves, not for you. Governments print to save the system, not to protect your savings. When the collapse comes, the prepared are those who refuse to believe in permanence. They hold value the system cannot dilute. History's survivors never depended on paper promises. They kept gold when coins were debased. They bought land when paper was inflated. They held foreign currency when their own collapsed. They had liquidity when markets crashed. And above all, they understood that skills and production can never be printed away. A farmer who grows food, a craftsman who repairs tools, a worker who produces something essential. These people endure when money itself becomes meaningless. That is the deepest truth across centuries. When money dies, what survives is always the same: real assets, real skills, and the awareness that no institution, however large, is unshakable. So ask yourself, as you hear these echoes of Rome, Byzantium, France, America, and Lebanon, what are you holding that cannot be inflated, frozen, or devalued by someone else's decision? Because history does not reward those who trust the most. It rewards those who prepare first, and that is why you are here. If you found this perspective valuable, and if you want to keep uncovering the lessons that history leaves for us, make sure you like this video, share it with someone who needs to hear it, and subscribe to the channel so you never miss the next story. History has already written the warnings. All we have to do is pay attention.